Today, we've got the privilege of chatting with Rob Mullin, the CIO and founder of Marathon Resource Advisors. And this is someone we've wanted to chat with for quite some time, isn't it?
He absolutely is, mate. An intriguing character, Rob is. Like, from San Francisco, of all places, the dichotomy kind of grips us. He's in the epicenter of AI, and here we are talking about beaten up cash flow, natural resources stocks.
Rob runs the Soul Fund at MRA. They are an asset manager purely focused on the natural resources space. So this gives us an abundance of things to talk about. He can invest anywhere around the globe in any commodity.
Since MRA became a long-short fund, returns have been bonkers, mate. 33% per annum annualized, an incredible year-to-date, 80-odd%. He sticks to his core, looking for cheaply valued equities, kind of counter-cyclical, understanding that these are cyclical businesses, and still thinks there's a lot of value in gold. Very attracted to energy.
Totally. And tacking onto that one, mate, he writes some of the best resource investor letters out there. Just gripping kind of stuff in the way he sort of sees the market, whether that be talking about private credit, private equity, pod shops, what they've kind of done to the market and how they've impacted the market, all the way through to generalist investors. Are they going to return to the market? Are they going to come to places like oil, metals, critical minerals? So really hope you enjoy this conversation with Rob Mullin. In an interview you did recently, you said we've done very well for our investors, having a very disciplined approach, buying companies the old-fashioned way. What does that sort of mean to you, and how different do you feel from the pack in this kind of market?
Well, I have kind of an interesting seat, right? I'm a resource guy, a fundamentally value-driven investor, who grew up right in the middle of Silicon Valley, and I'm right smack dab in the middle of some convergence of tech, AI, and crypto. So I can't possibly be pulled by different worlds any more strongly than I am currently. I'll even take that to a bigger extreme in that, my family heritage and the name of the fund is from Marathon, Texas, which my mom grew up on a cattle ranch out in the middle of a very, very quiet, desolate part of Texas, which is known as one of the most Republican, most conservative parts of the country. Flip side of that is I now live a couple of blocks from the corner of Haight and Ashbury Streets, which is, here in San Francisco, which is quite frankly, and I think it has been measured as the single most democratic zip code in the entire United States of America. So, I'm just sitting in the middle trying to make sure I don't offend anybody too much. But when it comes to sort of being a value investor, what it means to me is the ability to get comfortable with the underlying cash flow dynamics of the companies that you're investing in, the sustainability of those cash flows, and importantly, the willingness of the management companies to share those with you. Because big cash flows don't mean anything if they're just going to blow it on stupid stuff, quite honestly. So what it means is how fundamentally can I underpin or underwrite the value of my investments, given the cash flow that I know is going to be coming back at me. And I think while that used to be a fairly popular. It may not have been everybody because there have always been growth investors and people who have really gone after more exciting parts of the market. But you go back 30 or 40 years, the latter part of that is when I was kind of cutting my teeth in as an investor, and that was kind of standard operating procedure. You were looking to try and find a dollar's worth of assets and buy them for something less than a dollar, and I think that has become in this market something that's kind of anachronistic. There are very few people still left doing that kind of analysis because, quite frankly, for the most part, it hasn't paid particularly well in a while.
Yeah. I mean, that's so fascinating. And when you sort of talk about stocks that trade on 2 to 3 times cash flow, I don't know about other people, but that gets me super excited. But before we jump into some of those kind of stocks, I am very curious to know, given that kind of dichotomy of you sitting there in San Francisco, what the appeal of natural resources was I think in the 90s when you first jumped into that corner of the market.
Yeah. Well, look, having a family heritage on a working cattle ranch out in the middle of Texas, where they haven't actually found any oil and gas on the ranch, but they looked for it and they paid us some bonuses, so that was nice. But there's always been a little bit of an underpinning of, real working commodity resourcey kind of businesses in my family. But the real driver was, one of the things that kind of personally defines my skill set is I'm a very quantitative person. And by that, I mean, I've got a fluidity with numbers that enables me to build models and look at both absolute and relative valuations and try and discern value. And it's like, there's a combination of investing that is both a math problem and a little bit of psychology. And so if you can do the math side of it right, you can learn the psychology part of it over time. Bringing together those two things is very helpful. So when I was at the Franklin Templeton Group, I covered a bunch of different sectors. The resource sector was one of them, but I also covered consumer products. And the skill set required there was figure out, how popular Gillette's brands or Colgate-Palmolive's brands are going to be next year and what multiple the market will put on that. That's a very different skill set than, build me a discounted cash flow model so you can buy a copper company or an oil company for something less than what the current strip pricing would tell you is the cash flows that they'll produce over the last 5 to 7 or next 5 to 7 years. So with that kind of skill set, I've never been much of a fortune teller. I'm no good at telling you what app is going to be the most successful one or whether people are going to find it really important to get a seventh way to order a hamburger, via effectively a limousine to come to your house. That's never been my gig. It's really just going in and being able to understand companies and cash flows and hopefully have a disciplined process around that to be able to buy them when the market is giving you the largest margin of safety.
In the was it the mid 90s you kicked off the gold fund at Franklin Templeton, and we're going to spend a fair bit of time today talking about gold miners, gold stocks, and your views on gold. But
Mhm.
like when you first became acquainted with the gold sector, how were things different then from where they are right now?
Yeah, it's wild. So just full disclosure, I never ran the gold fund at Franklin. That was actually originally introduced in like the 50s. I think Marty Wiskeman was the original Franklin partner who brought that fund out. And while I definitely had a dialogue with the manager of that fund, it was never part of under my purview. I ran the natural resource fund there. That said, I came into the business when gold stocks were valued at, typically at least two times, if not higher, times NAV, where people were willing to pay a significant premium on to the market multiples on cash flow or earnings because they felt that gold stocks served a purpose. They protected you from what might be an adverse or inflationary outcome that, look, in the early 90s, the 70s were still a pretty vivid memory for a lot of the portfolio managers. Now, that portfolio manager generation has now more or less, I won't say they've died off, but they've gone into retirement. They're living on their boats, they're hanging out elsewhere. And gradually over that period of time, between us getting the world getting very comfortable that we're in a low inflationary environment perpetually, and the leaning in on the sort of move towards decarbonization and ESG, that embedded premium that gold stocks used to trade with gradually whittled away over an extended period of time to the point where there was a point earlier this year where the gold stocks had been cheaper on relative multiples, earnings, cash flow, even though they were generating fabulous returns on equity and returns on capital. They were at the deepest discount to the broader market that we had ever seen. They were the cheapest stocks on my board, with the exception of, like a few coal companies and some really out of favor energy stocks. So I think that's why people got so frustrated with gold stocks over the last decade plus after they peaked in 2011. Is that it just was like relentless. You could not win. The gold price actually did okay, but the stocks were demultipled or depremiumed into oblivion. And so what's changed over the last, gosh, let's call it 6 months, is that suddenly the businesses became so good that people had figured out that they needed to pay a little bit more for them.
Where do you think that kind of goes to? Do you think we get back to the two or three times cash flow days?
You mean 2 to 3 times NAV?
Yeah. Yes.
Yeah.
Absolutely.
I don't know. I don't know if we ever get back. I mean, it'd be really fun if we did, because despite the fact that most of these stocks are up a lot, so are the NAVs, right? And so they're still trading relatively cheap. I'm of a mind that if you have a real investment theme that the broader market is going to embrace, you should get expanding multiples on that. And that's what we've seen in areas like, AI power generation, where you look at a GE Vernova that's gone from, it was spun out at 20 times earnings, now trading at 50 times earnings because they sell the turbines that people need to build new natural gas fired plants to be able to actually build these new data centers. If you look at places like the European defense stocks, there you've seen massive multiple expansion too, as the reins have been taken off of the Europeans in terms of their ability to budget spend or deficit spend to be able to expand to take care of their own borders. And so, Leonardo has gone from 5 times earnings to 25 times earnings. The gold stocks are all up as a group, 100 to 150% this year, but the valuations have not expanded. And so that's an interesting thing that, has me typically I'd be pretty scared with these stocks having run as hard as they are. The fact that the multiples have not expanded makes me more comfortable than I would normally be.
I actually looked at all of the gold miner valuations. I think it was yesterday, and so there's only two miners with trading at about 2 times NAV, Lundin Gold and Agnico Eagle. I was surprised to see
Yeah.
Lundin Gold there, but like what you're trading relative to NAV depends so much on what your assumption of gold price is, and of course,
Exactly.
these gold stocks look phenomenally cheap if you assume that today's gold price is the new gold price into perpetuity. But everyone's
Yeah.
valuing these on a reversion to mean gold price assumption.
Yeah, if you mark the NAV to market, they're all super cheap. I will walk you through. I won't name the name of the company, but I will say, so this has been a portfolio holding for us for a couple of years. And they're in the process of building, what we think is going to be a pretty good gold mine. And so when we met with them at the Colorado Springs World Gold Forum meeting in September of 2024, the market cap of the company was about 600 million bucks, and it looked like they would generate about $300 million of basically free cash in the first year of production, which it is going to be 2027. And so effectively trading 2 times cash flow. So I'm like, great. Okay, that looks good. Comfortable as a portfolio holding. We go back this year. So this September. So 1 year later, the stock is up 250%. So the market cap is now or actually a little bit more. So it's $1.8 billion is the market cap. But the first year cash flow in 2027 is $900 million instead of $300 million. So it's still trading at 2 times cash flow. And actually, between then and now, you've taken out a lot of the execution risk. A lot of the big parts of the plant have been ordered. A lot of the pre-strip has been done. A lot of the potential, pitfalls that you get with any sort of ancillary permitting or anything like that have been worked through. So it's cheaper now than it's up 250% plus, but it's cheaper than it was a year ago. And it has been measurably de-risked. So that's the kind of thing where I have a hard time saying I've got to sell this stock because it's up.
How much a part of the narrative from totally out of fashion to the hottest thing since sliced bread in the scheme of this transition? Do you think the retail investors coming in and the flow starting to come in? We've started to see it happen, but we're nowhere near a sort of euphoric type place with regard to retail investors in the gold space.
Yeah. So that was the puzzling factor earlier this year is that, and then really over the course of the last several years, is that you had this massive, visible, overt buying of physical gold by global central banks, particularly Eastern global central banks. Um, and the reason that gold prices weren't going up faster is that the West was selling it to them. Right? We were liquidating our ETFs. We were, still had some Western central banks deciding to be marginal sellers, and so that kind of helped keep a lid on it. That's the narrative that changed this year for physical gold, which is all of a sudden the central banks are still buying, but and they have now company. It's more than just the, Turkeys and Russias and Chinas. You've added in things like Poland and others that have been pretty aggressive, and a lot of other central banks. So that's been part of it, but you've actually seen you've seen, as you say, the retail investors have started to join. So it went from having relatively balanced buyers and sellers to now everyone kind of on the margin is buying. And there are very few people who at this point are willing to sell their gold, except today we note that I think the gold price was down about $90 US in today's trading. So, maybe the correction that people have been waiting for a while has arrived. But I think that's part of the narrative. The interesting thing to me is that gold stocks still, the major gold stock ETFs in the US have still had net liquidations year to date. So that doesn't happen very often. I went back and looked at, gosh, I think 15 years worth of top performing ETFs and how often they had outflows. And it's about 3% of the time. And so it's a pretty unique beast to have the top performing ETFs having net outflows over the course of the year. The last I checked, the GDX in the US has still had net outflows of close to $3 billion this year. It's reversed a little bit in the last few weeks. So we've gotten $600-700 million worth of inflows. But, to have a vehicle that has performed that well and to have had net public liquidation of it is really kind of telling you something that I think it's not early, but it's not late by any stretch of the imagination.
When, when do things look like they're late?
You know, that's when you're starting to see. I'm looking for two different things. One of which is where you're starting to see, new share issuance by the GDX and the GDXJ start to go up markedly. So you don't just see it going up because of performance. You see the NAVs, or not the NAVs, but the AUMs going up dramatically because you're getting, billions and billions of dollars of inflows. Not seeing that yet. When you start to see, we've seen a lot of smaller companies do equity issuances. When you start to see the big guys do equity issuances because they're starting to buy other things and they don't really want to, issue their, do a lot of debt or things like that, then you're starting to get a little bit later in the game for sure. As in terms of yardsticks for me, I still look at where is the gold price and the US held gold relative, and how much does that cover of our foreign held treasuries? And so right now, the historical range on that has been anywhere from like 40% to 5% of basically us having enough gold to cover the entirety of the treasuries that we have issued to foreign entities. And so right now that metric is, call it the domestic stockpile of US gold is just over $1 trillion. We've got close to $10 trillion worth of treasury securities issued to foreigners. So I think it's about 11% right now. So, that would tell you that we're still relatively early in this process. But what I know for sure is we're never, and this is what I tell investors with us, we're never going to get the really easy, steady, up and to the right kind of bull markets that technology investors or healthcare investors get for these long, extended periods of time. We have signed up for a totally different rodeo in that we're going to have these sharp, brutal corrections that are going to shake your confidence to the very core. It's just what this sector does. It's what makes it so hard to invest in. And that's above and beyond the fact that environments where resource stocks are doing really well are inherently really volatile periods because inflation is rising, concerns are rising. That creates stress between equity and bond markets. And so it's almost like we are self-defeating because the goodness that comes with this broadening inflationary outlet comes with this massive volatility that you suddenly have to manage through.
It's what also makes the resource sector so fascinating to follow that dynamic of global in nature and very volatile. I'm curious to hear where you're seeing, just maybe rounding out on gold there, the most value, because you have a global mandate, and I think you said a few months back that overall you were relatively light on in North America. I think you said 25% of the portfolio was US, Canada. I'm not sure how much that's changed, but where are the pockets of value when it comes to gold?
Yeah. So gold, I think in some ways you have to look at almost a little bit of ancillary plays. So we came into this year very heavily positioned in precious metals, and we're still pretty heavy, but we've been trimming a little bit off the top. Where we're still comfortable is, at the valuations haven't expanded dramatically on sort of the resource asset managers. So, one of our largest positions is a company that has both commodity equity ETFs in gold, silver, platinum, uranium,
Sprott.
et cetera. So yeah. Yeah, so that's an area where, look, your downside risk is a little bit truncated because they're not going to get taken out by a single coup in one country or a tailings dam fall or a permit that doesn't go through. If the sector does well, they're going to do well. And it's typically something that will carry past the end of the cycle. So that's an area of exposure to us. I think there's still reasonably good value in some of these developers. So companies that are, maybe 12 to 18 months out from getting production online, because you have to do your due diligence on execution risk. But those are places where you can find, I think, some reasonable value. I also think that some of the things around, the blocking and tackling, I came away from, I met with like 40 companies over the course of, and myself and my colleagues met with about 40 companies in 10 days between Beaver Creek and Colorado Springs. And what we walked away with is, let's find ways to buy companies that benefit from people actually having to drill a lot more projects. So, drilling rig contractors and things like that, because, when you've got juniors raising a lot of money and having to keep up some news flow for their new investors to make sure that not only can they make them happy, the people who bought the last deal, but make sure you can get them excited to buy the next deal. You got to run the truth machine, and which is the drilling rig. So I think services around that are kind of an interesting way to position yourselves in the market now that we're moving into a sweet spot where enthusiasm is translating to having to put capital in the ground.
Yeah. The picks and shovels play is always interesting.
Picks and shovels approach? Picks and shovels in the resources space? Is that like Sandvik ground support?
It is. We're talking about businesses like Sandvik ground support, mate, because, well, there's always a booming demand for the world's best ground support, which we know there's infinite demand for that kind of product. But when times are absolutely humming in the resources space, infinite becomes even more infinite.
Do you know why I'm so attracted to the old DSI, to the Sandvik ground support business as well? Because they are the premier name in the sector, mate. The quality rises to the top, and these guys have mastered it in Australia.
What do you think Rob would think of someone who's a self-described quantitative guy? What do you think he would think of my statement that something infinite can become even more infinite? do you think he'd approve? Can I get a job at Marathon after this? Doesn't matter, because Sandvik ground support, they might give me a job because it's the best ground support. Maybe they need someone to sell ground support.
It'd be a privilege to work under Derek Hurd. Go Derek, go the Sandvik ground support team. And if you're a miner out there, get your order in today.
Get some ground support and improve my math. But the cyclical nature of them is like fascinating as well. I do think of this like phenomenon when it comes to like cyclical businesses where at the peaks of cycles, often the multiples look the cheapest, and it's at the troughs where multiples look the most expensive, just by virtue of the relative valuation and the compression of earnings around there. But I was struck, speaking of like energy stocks, when you've actually got what feels like a relative trough, and yet multiples are tremendously low. This is strange, right?
Totally. And I would say, what I try and do with the strategy that we manage, which is, try and have a kind of core book of these high cash generating, significant capital returning kind of companies, is in the best of all worlds. What you do is utilize downturns to acquire positive carry convexity. And what I mean by those two terms, the positive carry comes from the dividend yield that comes in with it. So you get, 5, 7, 10, 12% dividend yields, and that's your positive carry. That's what you're paid to wait. The convexity comes from low expectations on future earnings or future commodity prices and very compressed multiples. So when you're paid well to be patient, it's almost like you're buying a long duration option that pays you to own it. And so that to me, having been through a few or more than a few of these cycles in resources, that's the way you work your way through the choppy times, is making sure you've got a real core positioning in that kind of stuff.
Some of these energy names, to tease out what you're saying there, like 10+% dividends, and they're the unloved types of ones. They're the ones listed in perhaps London or Norway or these types of things. But when you put it all kind of together, how do you see that playing out from where we are today? How do you see the cycle playing out?
So what I will say is that the way we are expressing, the cheapest way that we're finding to express a positive energy bet is just as you said, a lot of the North Sea listed E&P companies. So whether that's Norway or the UK, it is, I think, in my career, it's unusual for me to be able to find these types of quality companies at multiples like this. And we understand why that is, right? Is that what's happened in the last decade in Europe has been the most, God, tear off your nose to spite your face regulatory and tax regime in the history of mankind. I think it's possibly the biggest own goal in the history of global capitalism, in that they shut down a bunch of perfectly functioning nuclear plants, as well as significantly discouraged domestic production of hydrocarbons, and left themselves wholly vulnerable to some combination of Russian pipeline gas and global LNG. And so, effectively that's happened is, German industrial production didn't fall for 40 years. It's fallen for 5 straight years now. And it didn't recover at all after COVID. And in fact, it's kept going down because there's no stability or no confidence in energy policy. So, with high taxes and high regulation, they've done everything they can to discourage local production. Question is that changing? And when you see who's starting to lead in the polls, if you're in France or if you're in the UK or if you're in Germany, you've got moderate to slightly right-leaning governments who I think have the potential to have a significantly more pragmatic energy policy. And if that's the case, if you can look at this like a rational human being, which may be a stretch for European politicians, but if you can be rational for just a moment and say, okay, it's cheaper to produce it domestically. It helps domestic employment. It helps domestic tax receipts. And oh, by the way, even if you're producing natural gas in the North Sea and delivering it, onshore via pipeline, it is wildly less carbon intensive, so much greener than shipping it in from Trinidad and Tobago, right? So it's the case for it is overwhelming. That said, it's not a sure bet, but that's why the stocks are trading at 2 times cash flow. So my thought on these is you've got really good companies, in terms of companies who have taken advantage of a cycle where all of the BPs and Shells and Totals have been encouraged to sell their boring stuff to invest money in renewables, which is crappy returns, but they've sold all these boring assets that are on the very, very cheap. And these 5 or 6 companies in the North Sea have gobbled all these up at super bargain prices. And they're just sitting there waiting for things potentially to get just a little bit better. And so, I don't think these are going to be 5 to 6 times cash flow businesses, but if they're currently trading at 1.5 times or 2 times cash flow and they go to 3 times cash flow, and they're paying you double-digit dividends annually along the way, that feels like a pretty good ride to me. And so that's the core of our energy exposure right now, is in kind of three different companies who operate in that realm.
And how about if you contrast that with the energy companies in the States? Because you've spoken about the sharp drop off in shale. Perhaps you've got a view that that's even sharper than other people might anticipate. But what do you sort of make of the multiples and the valuations that the companies, similar type companies trade at in the States?
It takes someone who's actually taken the time to understand what a decline curve looks like. And so, and what that speaks to is longer term capital intensivity. If you have a company that's predominantly shale oriented, you're going to be losing, 35-ish if it's a relatively mature base. If it's something that's growing, it's more like 50% a year in annual decline rate. So you are struggling to produce. If you're producing 100,000 barrels a day, you got to find 40 to 50,000 barrels a day of new barrels the next year to make sure you just stay flat. When you're talking about these North Sea assets, where you've got mature fields, where you're not talking about the same kind of massive upfront frac and rapid decline curves, if you're a 100,000 barrel a day producer, you only have to find 20,000 barrels a day, 25,000 barrels a day, maybe 15,000 barrels a day. And therefore, all of the cash flow that you're generating off of that 100,000 barrels a day, you're free to do other stuff with. You're free to buy back stock. You're free to pay down debt. You're free to pay dividends. You're free to make accretive acquisitions with cash, which means they are truly accretive. So that's the opportunity set that I see. And so that's uniquely to, I think that's more North Sea, and elsewhere. Most of the sort of headline names in the Permian, are of the first variety, which is rapid decline curves, where you don't have a lot of visibility of what that production curve is going to look like in 3 to 5 years. All you know is you're going to have to spend a ton of money between now and then just to stay flat. And so I don't find a lot of value in US based producers. I've got a few, and there's some good royalty companies in the US and Canada that I think are worthwhile vehicles. But that said, I just I'll take the European stuff just on a multiple reserve life, positive potential catalyst that's outside of just oil prices and gas prices going up. That to me is a much easier bet, and I'm being paid a lot better to take that bet as well.
Underpinning maybe some of the potential upside as well is like, have you had a look at the chart? It's just the gold price to oil price ratios, and just like how extreme things are on the high end from just a historical like basis over the last like 50, 60, 70 years. It's kind of
Yeah.
remarkable, with the exception of COVID.
Yeah, it is. I think I understand it, and I've had people talking to me about this for a year and a half, and like, does that make you want to go short gold and long oil? My answer is no, because
Yeah.
there's fundamental drivers behind it. Look, I was a presenter at the LBMA forum last November, so just under a year ago in Miami. And I had a chance to sit down, with some fellow presenters, a couple of whom were central banks. And, I said, look, just between, us two guys, you know, if we see a risk off situation where, treasuries are well bid and gold goes down, in theory, what do you think the global central bank community does? And they said they would take that as an opportunity to sell more treasuries and to buy more gold. So I think we're in a regime that's very different from what defined the 2020s, or sorry, the 2000s to 2020. That 20-year period was totally unique. Very low inflation, very low inflation expectations, and that's what gave bonds and stocks their anti-correlated feature. We're out of that realm right now. So that's what, if inflation's above 2.5 or 3%, bonds and stocks aren't inversely correlated. In fact, they're more likely to be positively correlated. So you need something else in there that acts differently, and gold is serving that purpose. But flip that to oil. I think the sentiment in oil is awful, which just makes me kind of attracted to it. I mean, I'm a, you know, I'm a metaphysical dumpster diver by, you know, by training. So that to me is where there's really interesting opportunity. Now, if you look over a much longer time frame, look at 120 years worth of history. There's a great guy, Rob Connor, who writes the Crude Chronicles. If you're not a subscriber to that Substack or follow him on X, it's worth doing. But the lesson of the last 120 years, if you look at whether it's gold, base metals, energy, agricultural commodities, they tend to travel together over time. And so from that perspective, I think gold is telling us something very interesting right now about where the rest of the commodity complex can go over the next 3, 5, 10 years. And I think if you listen closely, it's telling you higher. So you just need to think about that and maybe be a little bit patient. But this is the time to pick up that really inexpensive convexity in the energy patch.
So to tease that out even further, you've spoken, and I think you wrote in your quarterly, Rob, about embracing volatility, which is a fascinating concept. And it, yeah, for some of the listeners that might come from a more mining oriented background, it's a concept that might need a bit of breaking down. But essentially, we're in a world where the pod shops and all these other, you know, PE, private credit, are trying to eradicate volatility from their portfolios or make it sort of seemingly so from the outside. And again, you seem to be pretty attracted to doing the opposite. So I'd love to just hear your thoughts on how you embrace volatility.
Yeah. So understanding that we're in a volatile sector, you know, it's the reason why we feel so strongly about being long short and hopefully being able to offset some of your sector specific risk that way. But there's some risks that are just a little hard to offset, and those are broader systematic risks. And so those are areas where, you know, I went on a I guess you could call it a volatility journey back in the late, you know, for kind of 2016, 17 to 2019, really understanding how bringing in certain instruments, what I think the common terms would be either long volatility or tail hedge type of characteristics into a portfolio that, you know, and resources that's inherently volatile itself, often for very unusual or usual reasons, that having that long volatility bias gives you the ability to do some things that I think are very important. This sector in particular makes you feel like you need to sell things at the bottom because it hurts so badly, right? And it also makes you feel like you have to buy a ton more at the top because, man, it feels really good. There are ways that you can structure it from a security specific standpoint to be able to say, look, I'm going to spend, you know, 50 basis points, 100 basis points, 150 basis points of the fund over a course of 3 to 6 months, and just say, you know what, there's some ways, if I look across what I consider the kind of volatility surface of various instruments, where can I exercise this cheap convexity in a way that it might make me able to get exposure in some instruments that give me the ability to not only hold on to all of my stocks if the market drops significantly, but gives me actual dry powder to buy more. Because that is, you know, from, you know, this is, I don't even know how you would count the cycles that I have been through since I started managing resource money in kind of 1995. But the single biggest differentiator in long-term performance is being able to hold on to the bottom, being able to hold on at the bottom when everybody else is, you know, basically kind of dry heaving their portfolios. And in the best possible scenario, you have the ability to buy there. And that's what being long volatility enables you to do if you do it right. And look, I haven't gotten it right every time, but we get it right more often than we get it wrong. But the ability to really compound returns with that sort of opportunistic, you know, buying and then harvesting capital from volatility is just it's a game changer in terms of keeping you in the game when you need to be in the game, and enable you to buy more when, in my case, the 10 or 15% dividend yields go to 20 or 25. That's when you really want to be kind of backing up the truck.
With 80% returns year to date and 33.2% returns annualized since 2020, I think you're doing it right more often than not.
I can neither confirm or deny those numbers.
How do you think about the kind of unpopularity of what you kind of do? I mean, I know we started the conversation there, but even here in Australia, which is a resource kind of focused economy, we've seen a decline in the number of fund managers focusing on the space. I don't have as great an insight to what that's like in the States, but are these sort of conferences kind of poorly attended to, or are things perhaps changing in recent years with generalists starting to come and look at the space?
We're starting to see the very early stages of that in gold. I asked the sponsors of the last two events, both Beaver Creek and Colorado Springs, marginally more, a little more people, but not what you would expect with groups having done well. And energy conferences have now been very lightly attended. One of the things that I typically do is, as you say, fewer number of fund managers than there used to be. And I've worked with or shared meetings with the vast majority of them. I spent some time underneath Tocqueville Asset Management. So I got to know, John Hathaway, who's, one of the great grand deans and one of the real true gentlemen in this business. And you talk to someone like that, or some of the guys who have run, really good mutual funds in the sector for 10 or 15 years, or some of my former colleagues who are running some of the closed-end funds. No one's getting inflows, and this is for gold managers. Resource managers as a whole are getting outflows. So it's kind of like we've been deplatformed. And so for us in the US, where all the capital is gravitated to is the pod shops, is to the Millenniums and Balyasnys and Point 72s and those sorts of platforms where, they provide an infrastructure for people to run a very specific kind of resource portfolios, where they need to be very big liquid stocks. They need to be very balanced books, and they're trying to eke out, mid-single digit returns that they can then lever up 5, 6, 7 times, and generate a return stream that way. That's a very different beast. And I think that goes back to what you're talking about in terms of embracing volatility. Those managers, even though they run huge amounts of money on a levered basis, but they can't own these little eclectic, and by little, I mean, $1 billion, $2 billion, $3 billion market cap companies. If they don't trade at least 15 or 20 million bucks a day, they're not going to own them. So those are outside the realm of the majority of allocated resource investment dollars going on today. I also think a lot of the generalists have just disbanded whatever sort of segments of their resource teams that they had. I mean, when I was coming up in this business in the, mid to late 90s or the early 2000s, the BlackRocks and the Fidelities and stuff, they'd have fleets of analysts coming to, every one of the conferences. You just don't see them anymore. And even the good, sort of single strategy hedge funds, now 90% of their teams are effectively, tech, AI, maybe some healthcare, maybe some financials, but given the shrinkage in resources as a percent of total market cap and the relative diminishment of liquidity there, they're not there. The good news is that if we come through a period where the group starts to get back in favor again and the market caps grow and you get new issuance and all of a sudden they're going to be interested, but it probably is at levels 50 to 100% higher than where we are today.
Where do you think the world kind of goes with, as you mentioned, the millenniums, the Point 72s, the citadels of the world? I mean, these strategies have grown enormously and they're kind of swallowing the market in a way. But you had a great quote at one point where, you sort of said not that these funds can't work in the long term, but the strategy of eradicating volatility, as you sort of said, they haven't faced that massive GFC type moment or anything in a substantial way. And like the ones that did, they were much smaller back then, and they almost got wiped out. Some of them did kind of get wiped out. So how do
Yeah.
you think about the size of those funds in the market in 10 years' time, in 15 years' time?
Yeah, that's a super tough call because look, the return streams that they have generated for their investors, even though they charge enormous fees between A and B, the return streams to investors have been great, assuming the investors want that sort of T-bill on steroids. Give me my 1.5% a month and with very limited drawdowns, and they're perfectly happy. Um, you can do that as a, couple $100 billion industry. It's hard to do. It's hard to see the multi-managers as like a 500 billion or $1 trillion industry. Then if you're talking the leverage on top of it, it's like I don't think the math works in terms of the underlying liquidity in the markets where they're really generating most of their returns. So I don't think they can grow as much as they have. It doesn't mean that they're doomed or that they won't continue to generate, very attractive returns for a certain kind of investor set. But you bring up a good question, which is, it's the taller the pyramid or the taller the, sort of the tree gets, the bigger the noise it makes when you knock it over, right? And the more damage it causes. And so I think we're in a spot where if you see some of the wonky stuff going on in private credit, which to me has kind of been the duct tape and baling wire that's held together private equity, venture capital, commercial real estate, and even some other facets of the market, you start to see that liquidity drain coming out at the same time that you see broader liquidity start to dry up a little bit as well, and combine on that. The fact that passive flows, I'm not sure how much that keeps going. If you keep firing 250, U.S. passive flows that are highly dependent on 401k contributions, if you start to fire a bunch of, 250 or $300,000 a year programmers, firing one person like that is like firing five people who make $50,000 a year, and the impact on 401k flows is not insignificant. So there's some dynamics in place where we may get that kind of risk off sort of environment. And I'm just happy that volatility has been on sale and that the VIX has come down considerably, both in equity and in rates, and also in broader, in currency vol. So that to me is a healthy allocation for us. And look, I don't wish ill on anybody, but there's a part of me from a purely selfish standpoint that would love to see a really inconvenient fourth quarter of 2025, shock to the system that takes the market down takes the market down 5, 10, 15%. Because the other part of this is that as much as I'd like to be a buyer of volatility when it's cheap, there are a number of entities out there that have been pretty rabid sellers of volatility into every decline. And when you're a seller of volatility, you're kind of picking up nickels in front of steamrollers, and it's worked. But that doesn't work forever. And if, there's a great old New Yorker cartoon, there's a guy, it looks like a guy in a tattered suit sitting on a street corner, and he's holding up a sign with a little cup looking for people to, donate to him. And he said, "I bought the dip, and then there was another dip." So that's the kind of thing that if you're a volatility seller, and that's what they've been Pavlovianly trained to do, is sell vol into every sell-off. They did it during COVID. They did it during the taper tantrum. They did it during, Volmageddon back a couple of years ago. You get that second leg down, and all of a sudden someone who's selling, 25 or 30 basis points of volatility in their portfolio and thinking, hey, this is a great way to pick up a little bit of yield, and that triples or quadruples on them, and they're trying to figure out how to tell their investment committee they lost 150 basis points in 3 days in a market where all the rest of their stuff is melting down. That's a very different argument. And I think you could see the pucker factor come pretty rapidly if we get that dip, then a second dip. And so, I think there's going to be value to long volatility here. Whether it happens this year or not, I have no idea. But at some point over the next 12 to 18 months, I think a market as richly valued as it is right now, and as I think fragile from an incremental flow standpoint and built on a, layer after layer of kind of opaqueness in these private credit instruments where we just don't have a lot of visibility. And we're seeing that now with a couple things that happened in the US with First Brands and a few others where, hey, we said there was collateral here, but actually, sorry, there's not. And so that calls into question the entire underwriting standard of the whole industry. And I don't think the whole industry is a fraud, but I do think there have been some bad credits underwritten. And the question is, how much more of those, dead fish are going to float to the surface here over the next, couple, 3 months?
You've got great insight, which I think might be a bit, minimized by some people here when you talk about like investment committees and how these bigger investing operations around the world manage themselves and the time it takes to kind of get things done. When you talk about that kind of bearish sense of the market, I think a lot of us here are sitting pretty confident because resources have started to work for a little while now. But I'm really curious to hear from you, Rob. What is the world in which things don't quite go well for all of us in this end of the market? Like, what's the bear case perhaps in the medium term for all the names we're looking at?
So I think what's driving the broader reach towards tangible assets is the realization that kind of excessively spending governments and government budget deficits and having to fund these things is having a really adverse impact on the credit side of the global marketplace. And so, what could potentially improve that? Okay, look, if AI is wildly successful in increasing productivity, to the point where companies get way more profitable and taxes increase. And so you start to get something closer to, kind of balanced budgets or deficits at least go down. That drives an excitement that might not be great for 50 or 60% of the companies in the S&P 500, but it doesn't matter because all the market cap's in the top, 25 or 30 names anyway. So that, in theory, could drive a reversal of what we've seen this year, which is a little bit of a growth to value rotation, and and a US to global rotation, and those two things typically happen at the same time. Um, that feels really good to us. You know, could that reverse? Absolutely. But, given if you've got great news on budget deficits, if you've got a calming down of geopolitical tensions, if you all of a sudden have the U.S., China, and Russia sit down and say, "Kumbaya, we're all buddies again, and we don't have to worry about, reestablishing supply chains all over the world. So those incremental costs are going to go away, and the tariffs are going to go away." And yeah, I think that's a not it's not a zero probability. I think it's a pretty low probability, but I don't think it's zero. That would be the environment where I think you could see a sell-off in everything that we do. Flip side of it, or not the flip side, the other thing that you have to kind of worry about is, what if we have this massive structural risk-off kind of move, in which case most of our stuff's going to go down too. I think in particular to gold, I think it will go down less and it will recover the fastest. We've done a lot of work. The last 5 major corrections of the US 60/40 portfolio, gold on average has had half the drawdown and has recovered about 70% faster. You could look at that very linearly around the tariff tantrum. Gold fell roughly, I think 1/10 as much as the broader market and had recovered its old high in 2 days after the bottom was met.
And this is
Compare
bullion,
that.
not the equities.
So that's bullion.
Yeah.
But the equities, quite frankly, weren't super far behind. They kind of followed, and they were back to highs, within probably less than a month. It took almost 3 months for the broader S&P to get back to flat. But if you look at that analysis across the last 5 major, drawdowns for the 60/40 portfolio, that's that consistently gold has, we know the playbook is if markets are rough, the central banks will print eventually. And, and when they do, gold's going to be the primary beneficiary. It's sitting closest to the door. When the appetizers start getting served out of the kitchen, gold is the one right next to that door, and they start gobbling it up first.
We haven't even asked you yet. You talk about the the taper tantrum, the impact of tariffs, and what the Fed might do. Something the US government has been doing is writing checks to resource companies, MP Materials, US Antimony Corp, and these sorts of things. How are you kind of digesting that, and what are you making of some of the valuations? I mean, some of the stuff we kind of see here for Mountain Pass neurology plays and the like are absolutely astounding. They're just gobsmacking for companies that have nothing but moose pasture. So how do you digest all of that?
So the lesson from all of this is anything that sits in this kind of realm, you just can't be short. And so this is speaking as someone, I was short MP Materials into because look, the business is their processing business. It's not a good business, and never has been. And without government support, it never would be. So it tells you can't be short. It tells you that if you're gonna play in that realm, at least try and find the quasi-real businesses. The tough thing about this is, and this is coming both from industry and from people that I know who are kind of close to, various government agencies and the contacts that they have there, is that it's not the best companies that are getting the deals, right? That are getting the support. It tends to be a little bit more, who's the most politically connected, who has been the most effective lobbyer of the current administration. And so, look, I wish the money was being spent better. But that said, it does mark a quantum shift in the way that resources are viewed as a strategic imperative for governments. And I think inherently that is a good thing, because if we continue to go down the path that we were going down, we didn't have the ability to have a functioning military for longer than 5 or 6 weeks if the Chinese decided to cut off the, various, whether it be germanium or rare earths or all the sorts of things that they both produce and refine. We had backed ourselves unknowingly into a wildly indefensible and vulnerable corner. And so now we're starting to get out of it, and we realize we have to do so with some sense of urgency. So, look, I get it. If I was in their seat, I'd be spraying the money hose a little bit differently. But that doesn't change the fact that the money hose is in their hands. And so, kind of put yourself in the way. We don't do a lot of that stuff because none of it is high free cash flowing, and very little of it is in capital return mode. That said, we've got a little basket of kind of critical metals and strategic metals where, real underlying assets and businesses that, yes, we're paying a lot more than we would normally like for. But that is the nature of the game today, is that, we're not going to get these things at, 0.4 times NAV anymore.
I can't let you go without just sharing your thoughts on uranium as well, Rob. I understand because Kazatoprom's your preferred way to be long uranium, but someone that's clearly follows super closely energy markets, the E&P world. Like, how do you think of the uranium valuations in space right now?
So the way I typically quantify this is I rank my zealots on a scale of 1 to 10 in the resource spectrum. So gold zealots, I think, kind of weigh in at about a 6.
Yeah.
Silver zealots are probably like an 8.5 or 9.
Oh, they're 9.5.
And the uranium guys are like a 12. They're off the end. If you've ever seen Spinal Tap, it's like it goes to 11. So that's the uranium bulls. And unfortunately, valuations have followed. So it's super hard for a guy who pays attention to NAVs and free cash flow yields and that sort of thing. So, I've got a couple of small positions in the space where I think we've got some assets that offer wildly higher convexity. So like, a 1 or 2% position that, if we're really right, can act like a 4 or 5% position. But it's hard for me to own. Our exposure there is actually via the same, our biggest position in gold, which is Sprott. And when you've got an asset manager that's now a third of their book is uranium, whether it's through the physical uranium trusts or whether it's the actively managed Sprott ETFs or the passively managed ones, that's a $10+ billion asset manager. So I think if that part of Sprott traded separately, I would love to see the multiple that the uranium, yahoos would put on it. So I mean, I'm sure it'd be trading for probably double what the entirety of Sprott trades at today. So maybe they'll get the notice and buy a little bit of that. So I love the theme. It makes all the sense in the world. If you really care about carbon emissions, you've got to care about uranium. I love me some yellow cake. It's just hard for me to express from an equity standpoint and really feel like I'm giving my investors a margin of safety.
Maybe just as a thought exercise, but do you see a similar type US government handout, if you like, to a uranium project or uranium company within the States, like a Mountain Pass type deal?
If you look at a lot of the U.S. uranium stocks, they seem to be already discounting something like that. Some of them have got, as they say out on the ranch in West Texas, they've already gotten their giddy up, and that's, so I think that would not be a surprise. Would all the stocks go up on it again? Yes, I'm sure they would. But with stuff trading at, now kind of, 2.5 to 4 times NAV on current spot prices, you really got to believe in kind of $150 US uranium to make a lot of this stuff work. And yeah, I have no doubt that we'll get there, over the course of the next 3 to 5 years. I'm reluctant to pay for it today.
Absolutely, Rob. I could chat with you for hours and just sort of listen and learn from your perspectives and your experience and how you think about the market. So, thanks a lot for coming and joining us on the show today.
Oh God, this is a real treat. Look, I've been an admirer of your work, and you've had some people on, incredibly great people in your recent shows in particular that I've really learned a lot from. So to be now amongst the people who you've had a chance to speak with, I'm honored. And at whatever point you feel like you want to hear a little bit more from me, just let me know, and I'd be happy to come back on.
Very intrigued to eventually learn what stock you're going to be pitching at the Heart, Song and Mind conference in November in Sydney.
November 14th in Sydney.
We'll be watching. Awesome. Thanks, Rob. There we go, mate. Rob Mullin, an abundance of knowledge. I am very stoked we finally got him to share his thoughts on Money of Mine, and all that's made possible by our fantastic supporters at Sandvik Ground Support, Focus, the platform by Market Tech, and iMark. Conference coming up very soon. Get your tickets.
We'll be there.
Investors go free. Hoodaroo.
Hoodaroo.
Now remember, I'm an idiot, JD's an idiot. If you thought any of this was anything other than entertainment, you're an idiot and you need to read our disclaimer.